So IAS 16. So we have IAS 16 and you have the IPSAS 17. So we have two different items here. IPSAS 17 talks about property, plant, and equipment, and purposely, this one is for the public sector accounting, that is the government. So this one is for public sector accounting, public sector. Then we have the IAS 16, the property, plant, and equipment. This one purposely, so this one is for the public sector. This one is for the public companies or private company. Public, public limited company or the private limited company, that is under specifically for the companies listed in are listed in Nairobi Stock Exchange, NSE. So companies listed in Nairobi Stock Exchange. Now let us see some of the function of IPSAS. Some of the function of IPSAS. Number one, it improves transparency in public financial reporting. That's number one. It improves what we call transparency, and then it also improves management of public resources. It improves the management of public resources through accuracy reporting. It also supports accountability of the public resources. So it does also allow what we call the accountability of public resources. It also enhances comparability of the government financial statement. Government financial statement. So it enhances what we call the comparability of the government financial statement, because we are if a particular ministry is using the same IPSAS, then it allows what we call the comparability. Yeah, another thing is about responsibility. So it enhances fiscal responsibility and transparency. Fiscal responsibility and transparency. So remember, when we talk about the fiscal responsibility, this refers to the way through which uh, um, the resources are well utilized efficiently, prudently, and sustainably. Then we talk about physical transparency. Physical transparency is about the openness of the government resources. So to make sure that the resources are well used. So there's that openness in within. Then you have the general accepted accounting principles. General accepted accounting principles. So we talk about the general accepted accounting principles. These are all the sets that we have talked about from the legal sources. So when we combine the legal sources to professional sources to what? To the accounting standards. When you combine all those links together, it is what forms the general accepted accounting principle. Though indirectly in Kenya we don't say GAAP, but if you go to United States, they mostly use general accepted principle. But when we come to Kenya, we use the IFRS and IAS. IFRS and IAS. So GAAP is like a wider something. It's a wider a group of standards with other standards, local and international. Now in Kenya, we don't say we are using GAAP, but say we use the accounting standards. But if you go to United States, you can get this word. It's more common, GAAP. But either way, it is the set. Now refer to the common set of rules, standards, and procedures used for preparation of the financial statements. So in Kenya, GAAP includes the local and international framework, the IFRS, the IAS, the Company Act, the the CMA, the International Accounting Standards, and any other standards available. Then let us see the function. Number one, it is used for standardization of reporting or standardizing financial reports. So let us explain what we mean when we say standardization of report. We say it provides uniform structure for recording and presenting financial statements. So it provides a uniform structure for recording and presentation of the financial statement So that's the word from the word standardize. It gives us a uniform structure. So from the word standardize, it gives us a uniform structure. Number two, transparency and accountability. It ensures the financial statement are true and fair. This one means it ensures financial statement reflects true and fair value of the company. Reflects true and fair value. The fair value of the company. True and fair value of the company. Then you have the legal and regulatory framework. This is about compliance. That one is about compliance. So it helps the company to comply with various rules and regulation. Basis is a repetition. We have it here. It provides a basis for audit and regulatory enforcement. So when we talk about basis of auditing, the IAS provide the basis for auditors do what to do auditing. So if the company has used the required IS, then it will form a base for providing audit procedures. Now the last one is facilitate the decision making process. This one is through helping the users of this information. So when you see the word decision making, remember we're talking about the users. So the users can draw conclusion of the financial statements in order to make the final decision. So it helps them to make conclusion concerning the financial statement, whether to do business with the business or not. But that is through the financial statement. Let's go to the next item. The next item. Let's talk about stewardship. Stewardship, ethics, stewardship, ethics, and economic decision making. So let's talk about those three items. So when you talk about stewardship, now stewardship in accounting refers to the responsibility of the management or those charged with governance to protect the resources of the entity on behalf of the owners. A good example is if you have done financial management or finance somewhere, is for example is the relationship between the principal and the agent. So this is a good example. Now the principal is the owners. The principal are the owners. In this case, talk about the owners, while the agent is the management. So the management is given power to control the resources of the owner and make sure that the resources are safe. So that is what we mean by the word stewardship. So this one brings about stewardship. So the management, so the principal employ the agent to work on their behalf so that they can protect the interest of the principal. So the principal employ the agent, so the agent work for the principal and also to protect the interest of the principal. So the principal is the owner, the agent is the management. So that is the concept of stewardship in another way. So it refers to the responsibility of the management or those charged with the governance to protect the resources of the entity on behalf of the owner or the stakeholders. So we have relevant bodies that uses stewardship. Number one is the public entities. So public entities, that is the government. So it's a good example. So the principal is the citizens. The citizens. Then the agents are the government officials or the government employees. So the government is supposed to provide service to the citizens. So for the benefit of the citizens. So that's a good example. Then we have the public and limited companies. That's a good example of the owners and the management for the public companies and private companies. Then you have the NGOs and the charitable institutions using the donor fund. So the donor fund, so the donor fund, the donors are the owners. Then the NGO itself is the management. So the NGO safeguard the resources of donor to make sure that they are well distributed to the people who need them. Now, let's see the importance of stewardship. So, why do you think it's important we have stewardship? Now, one of the thing is accountability. So, stewardship brings about accountability. Now, if the management is responsible to the owner, it will bring about accountability. If there is no any conflict of interest, in case there is no conflict of interest, assuming now, in this case, while we are studying, we are assuming we are making an assumption that there is no any conflict of interest in between. So, meaning what the owner wants the management to do, the management does. So, accountability. It also brings about transparency. So transparency is about the management make sure that they provide all the relevant information to the owners in time. Then it trust. So when these two people, the management and the owner, work hand in hand together to promote the institution, then to bring about trust. Then also compliance. So when the management works in accordance to the law, they follow all the rules and the regulations, the accounting standards, the compliance with the Kenya Revenue Authority, with other regulatory body, then it will promote what we call the adherence of to legal and financial reporting. Also, resource optimization or better use of resources. So when the management comply to what the owner want and they work hand in hand, then the resources will be well utilized between the management and the owner. So the resources will be flowing from those two people effectively to allow what we call better use of resources. So those are important of stewardship. Stewardship means when we have the one person, both parties are responsible to each other. So when we talk about stewardship, it means one party is responsible to the other party, and the other party is also responsible to the other party, so that it brings coherence between the two. Then let's talk about the accounting ethical principles or the ethical principles. So these are the moral values which governs the behavior of people. In this case, it governs the behaviors of accountants. So because we're talking about the accountants, we're going to talk about accountants. So these are the moral values and professional standards which governs the behavior of the accountants. Now, it is this moral behavior is conducted by ISPAC, but ISPAC uses these codes as in accordance with IFAC, uh, professional accountants. So IFAC gives the codes to the ISPAC, then ISPAC gives the codes to the people so that the people should follow. Let us see those codes. Number one, integrity. The integrity means being straightforward and honest and truthful. So be a truthful man. So in short, it means you be a truthful man. So being straightforward, honest, and truthful. Number two, objectivity. The word objective. So do not as a professional accountant, do not allow biasness, do not allow conflict of interest, and do not allow undue influence. So what does all those items means? So it means that you don't do something. For example, when we talk about conflict of interest, so you don't do something to benefit someone who is close to you. And do influence is you can be influenced by another person to do something which is bad. So do not allow those items. Professional competence and due care. This is to maintain up-to-date knowledge and deliver service diligently without fair, without biasness. So professional competence and due care is another ethical requirement. So that is to make sure that you have updated information and you deliver the services diligently or with diligence. Confidentiality, this one talks about in the place of work, you do not disclose information that you have acquired them professionally without prior knowledge of the authority or without the authority giving you the authority to disclose the information. Then professional behavior. Now, professional behavior, it means you comply with the law, So you make sure everything that you do complies with the law, and you don't do anything that discredit the professionalism. For example, misconduct, sexual harassment in the business. All those are some of items which discredit the professionalism behavior. Good. Let's see function of ethics. What are some of the function of ethics? Number one, it promotes public trust, obviously. So when we have good ethics, then it brings about trust. It also prevents fraud and manipulation of the financial statement. If you promote what we call professional competence and due care, then it will prevent those items. Compliance, so it will ensure compliance with the standard regulation. That is, when you do what we call professional behavior. Then it guides accountants on ethical dilemma. So when you are in this place where you don't know what is right and what is wrong in a particular scenario, then this principle will guide you to make the relevant decision so as to promote what we call accountability, uh, ethics. Number five, it brings about good reputation. So it brings about good reputation. That is so when you follow the ethical uh, principles, then automatically it will support what we call the reputation and the credibility of the professionalism. Now let's talk about the economic decision making. Now, economic decision making refer to the use of the financial information used by the various stakeholders. So those are the users. Various stakeholders, we call them the users. The users to make rationale and decision making. To make rationale and decision making. The key stakeholders are the users. So we have just talked about it. The key stakeholders are the users of the financial information. Let us see the role of accounting when it comes to the economic decision making. Number one, it is the role of the accounting to provide timely and accurate financial information to the users. So it is the role of accounting to make sure that they have provided timely and accurate financial information to the users. Number two, accounting allows or enables comparison of financial performance across periods within the company or comparison between one company to another. Also, the accounting help in economic decision through evaluation of the investment opportunity available in the business. Also, it facilitates the risk assessment and financial planning. It also support budget comparison. These are the normal things that we need to know. So having said that, I think we are done with the stewardship, accounting ethics, and economic decision making. So we are remaining with the two items. One of the item is characteristics of the financial information, and the other one is the accounting concepts. So I think we need to let us do characteristics of the financial information, then we complete with accounting concepts, then we complete with accounting concept with accounting concept. So having said that, let us talk about the qualitative financial information. So not qualitative, qualities of financial information. Qualities of financial information. So let us see the qualities of financial statements. So we talk about not qualities of financial statements. Now, when we talk about qualities of the financial statement, it means that these are the attributes that make the information provided in the financial statement useful to the users of that information. Now, if the information provided in the financial statement are not useful to the users, then it will not form the qualities of the financial statement. It must form the basis where the users can make decisions. Now, we have two types of qualities. We have the quantitative characteristics. We have quantitative characteristics, and we have enhancing qualitative characteristics. So we have quantitative and we have enhancing. Let us start with the quantitative characteristics. So qualitative characteristics is divided into two. So it is divided into two. We have the relevance and the reliability. Now, for the relevance, it is the ability to influence the economic decision user and is provided in time to influence the decision making. That is the word relevance. To be relevant. So for anything to be relevant, it must be provided in time so that we can make use of that information. So that is what we mean relevance. It is the ability to influence the economic decision of the users by doing what? By providing relevant information in time. Now, the nature of the information is also affected by what we call materiality. So the nature of the information provided in terms of relevancy is also affected by what we call materiality. So we shall talk about materiality later because materiality is an accounting concept where it means that um, any information, if it is omitted, would affect the decision maker. That information will be considered a material. So that's a concept. Now, but for now, relevance refer to any information if released will affect the decision making process. Number two, reliability. Now, reliability, when we talk about reliability, it's about being reliable. Being reliable. So information is useful when it is free from material error, bias, and can depend upon by the user to represent faithfully that which it purports to represent and could reasonably be expected to represent. Now, information is reliable. Now, this is what it means. Information is reliable if number one, it does not have any error. Number two, it does not have what we call biasness. That is number two. And that information should reflect faithfully what it purports to represent. Now, if it represents that the information can be relied upon, then it should represent that information. So, if it purports that the information is true, then the final outcome, the information should be true. So, the information should be faithful or should represent faith. Where is it? And can be depended upon by the user and can be depended. So the user can depend this information if it represents what we call the faithfulness or faithfully what it purports. So if it purports to represent faithfully, then it should do what? It should represent the faithfulness. Or if it represents faithfully, then um, we should expect that that information is faithful at the end. So what it purports to represent it is what it should represent at the end, or should be the expected outcome at the end. Now, reliable information has the following characteristics in it. Number one, it should be represented faithfully. And remember what I have said. Be represented faithfully. What does it mean? So this one means if it purports that it represents the information faithfully, then it should fully it should be faithfully represent that information. So if it purports that the information is faithfully, then at the end the information should be faithfully. Number two, be accounted for and presented in accordance with substance and economic reality and not merely the legal form. This is what we call the substance of a form. It's an accounting concept, substance of a form. So that means substance of a form. We shall talk about substance of a form later as an accounting concept. For now, just say that one. Number two, be neutral, i.e., free from bias. Be neutral. It's supposed to be neutral. That is free from bias. I think that one is okay. Okay, next. Include some degree of caution. So when we talk about reliability, it must include some aspect of caution, especially where we have uncertainties. and that is what we call the prudence. So prudence is also an accounting concept. We shall talk about it. Let's write it in black. Prudence concept is also an accounting concept. We'll talk about it later. It also should be complete. So when we talk about ability, be complete, i.e., it must be within the bound of materiality. Remember, materiality is an accounting concept. We talk about it and the cost. Then an omission could make the information to be false. An omission could make that information to be false. Then once we are done, so since we are done with the qualitative, let us talk about enhancing qualitative characteristics. Enhancing qualitative characteristics. Number one, comparability. Now, comparability means you can compare the information or the items within financial statement with another. So enable the users to identify and understand similarities among items. So it allows the users to make similarities among items. That is what compare, from the word compare. Now, comparability is not the same as consistency. Now, consistency is where we use one method from one period to another repeatedly. So that's what we mean consistency. So consistency is not the same as comparability. So comparability is where we can have similarities among items. But when we talk about consistency, it's where we use the same method for the same item from one period to another. For example, depreciation. We can use depreciation. Can use straight line method from one period to another, as a method. Then we have verifiability. We can easily verify the information. So we talk about verifiability from the word verify. So it means that different knowledgeable and independent observer could reach to a consensus, although not necessarily complete agreement, that particular depiction is faithfully represented. Now, for example, when we talk about verifiability, even a doctor can verify that statement by just looking at it and come up to a conclusion that the information is faithful. The same, another person, not a doctor, can be a lawyer, can also use the same information to and verify it and make a conclusion that that information is faithful. So different knowledgeable and independent observer, for example, a doctor and a lawyer, can look at those information and debate that it is faithful, even if they are from the different fields. Timeliness now means that having the information available to the decision maker in time. So from the word time, timeliness. So for this, if for these characteristics to be useful to the user, the information must be provided in time so as to enable the user to make the decision. And also the last one is understandability, from the word understand. So the information must be easily understandable by any person. So it involves clarifying, classifying, characterizing, presenting information clearly and concisely, to make it understandable to the users. To make it understandable to the users. So those are some of the characteristics of the financial statements or qualities of the financial statement that you might find for the purpose of explaining those characteristics. Now I think we are done with qualities of the financial statement. So the last item, which will be the end of this topic, is about accounting concepts. So let us talk about accounting concepts. So guys, let us complete the last part. That is accounting policy, accounting base, and accounting concept. Now when we talk about accounting policy, these are the specific rules and regulations which governs the accounting method applied by the organization. So these are the specific rules which governs the accounting method applied by the organization. For example, a company can use LIFO or FIFO method. Now, these are the method for valuation. So we talk about this method as the method for valuation. for valuation stock, for valuing. There are method of valuing stock. So these are the method of valuing stock. So when we use LIFO, it means we value our stock on the basis of, so we value our stock on the basis of last in, first out, first out. So that is what we call last in, first out. So last in, first out, LIFO. And then when we value our stock based on FIFO, it means first, first in, first out, first out. So that's a good example of an accounting policy. How to value stock. We can decide to use LIFO or FIFO. You start with the to value stock from the one that you zilikuja kitambo or from those zenye ulizileta juzi juzi. So first in, first out, or last in, last out. Then you have the accounting base. Accounting base, these are the methods available for use from which the firm chooses their policy. So these are the methods available for use from which the firm chooses their policy. For example, we have depreciation. Now, out of depreciation, depreciation of non-current assets, we can use an accounting policy. Which policy can we use here? So this depreciation is an accounting base. So accounting base, these are the methods available for use, which the firm can use from, so that they can use an accounting policy. Now, this one is an accounting base. Now, from the accounting base, we can use the accounting policy. So, which policy? You can use either reducing method, as a now policy method, reducing method, or the straight line method. Straight line method. Now, remember these two are the policies, but these policies are derived from the accounting base. So, the accounting policy that we use is derived from the accounting base. So, the accounting base is a broader one, then we choose the accounting policy. Then we have the accounting concepts. The accounting concepts are also called the accounting convention or the accounting principles. So you can call them the accounting concept, convention, or principle. These are the broad basic assumptions that underlie the periodic financial accounts of the business. So those are the assumptions that we use to prepare the financial statement. So in short, so we talk about the accounting concept. These are the broad assumptions that we use when we prepare the financial statements. So we have various, we have 13 of them. We have 13 of them. Number one, going concern assumption. Now, the going concern assumption states that the business will continue to operate in the next foreseeable future if there is no intent to close the business sooner. So, what does it mean? It means that the business will continue to operate or will be there in existence, will be existing in the next foreseeable future if the business is not going to liquidate. Now, in case the business is going to liquidate, then the going concern assumption will not be available, or it will not be applicable. It will not be applicable. So you need to know that when you talk about the going concern assumption, we are talking about the assumption that we are making an assumption that the business will be there in the next 12 months or in the next 1 year, and there is no intention to liquidate the business any sooner. So the business will operate on a going concern assumption. On going concern assumption. That is correct. Number two, so that's what I'm saying, that the enterprise will continue in operation existent for foreseeable future. For foreseeable future. What does it mean? It means that the entity assumes no intention or necessity to liquidate or curtail significant scale of operation. So what does it mean? It means that the business is not going to cut its operation or is not going to liquidate. Now, but if the business is going to liquidate, now if the assumption that there is an intention for the business to shut their operation, the going to concern assumption will not be applicable. Number two, Number two, talk about the accrual concept. Accrual concept. Now, for accrual concept, revenue and cost are accrued or are accrued. What does it mean? It is recognized when they are earned or incurred, but not when the money is received or paid. That you need to know that one. So we only recognize revenue when we incur them. So for revenue, this pen is not writing. Now for revenue, so we recognize revenue. So we only recognize revenue when we incur them, when we earn them, not incur, when we earn them, even if we have not received the money. So for example, a customer comes and take goods on credit. Now we have set our revenue, our goods on credit. Now it means that we have earned them. Though we have not received the money, but we have earned them. Now we recognize it. Cost. We recognize them when it is incurred. When it is incurred, even if we have not paid them. So we can incur cost, but we have not paid them. I hope you are understanding. So that is what we call the accrual concept. So revenue is recognized when they are earned and not when the money is received. Costs are recognized when they are incurred. For example, unaweza ununue goods kwa duka lakini hujalipa, so you have incurred the goods. So you have incurred the goods because you need to pay them later. So you have incurred them. Even if you have not paid, you recognize them. You have earned the revenue. Even if you have not received the money, you have earned them. Umepeana goods on credit, but you expect that you shall be paid later. So you have earned them, but you have not received the money. So you recognize them when you earn them and not when you receive the money. The cost you have incurred them. So umeenda ukachukua goods on credit, lakini haujalipa. So you have incurred them. So you recognize them even if you have not paid the money. Next, let's go to prudence concept. Now, prudence concept is an accounting policy of caution. So remember, I had mentioned something to do with caution. So let us use this item here. Prudence concept is an accounting principle of caution. It's an accounting principle of caution in financial reporting where revenue and assets should not be overstated. Where revenue and assets should not be overstated, and expense and liabilities should not be understated. Expense and liability should not be understated. Then, so that we need to know. So when we talk about prudence concept, just remember we're talking about the concept of caution, being caution when it comes to uncertainty. So when you have any uncertainty, then we must be caution. That is the concept of prudence. So it's an accounting policy of caution in financial reporting where revenue and assets should not be overstated and asset expense and liability should not be understated. Now you need to know this. In the case we have a conflict between prudence concept and accrual concept. So if accrual concept conflict the prudence concept will always prevail. Reason why? Because of the aspect of being caution. Because of aspect of being caution. Let us do an example why accrual concept will not prevail in case they have conflict with prudence, but prudence prevail. This is it. Now let us assume that this revenue of ours earned. Remember, we have earned the revenue, but we have not received the money. Now, if we have earned the revenue, let us assume that the person is declared bankrupt and he will not be able to pay that money. Remember, in our statement, we recognize it as earned. But in the future, that person might end up not paying us. Now, accrual recognize that we have earned the money even if we have not received it in the statements. Now, prudence put a caution in case we don't receive this money, what will happen? Now, we are saying that the prudence concept will prevail because of the caution that money might not be received. In case it not be received, then prudence will stand and do what? And counterattack the accrual concept that money has not been received. so that we do what? Maybe we do a provision for that amount from the prudence concept, because the prudence concept is about caution. So if we have a caution that that money will not be received, then we put what? A provision that we have not received that money. So we put a provision to do what? Uh, to just bring to compensate that amount. So that's why we are saying that for accrual concept, why this pen is not writing? Now for accrual concept, it recognizes revenue when it is earned, even if we have not received the money. But for prudence, it recognizes the revenue when the money has been received. So this one recognize revenue when earned, and not when the money is received, and not when money is received. Now for the prudence, because it is something to do with cautious, now it recognizes revenue when money is received. Now if not received, if the money is not received, it means that we need to do a provision, and therefore in that case prudence concept will always prevail over the accrual concept. Next, consistency. This is simpler. Similar treatment of like item within each accounting period, or from one period to the next. So similar treatment for like items. So it means that we shall have similar treatment for like items, or for the same item. So that is what consistency means. So for consistency means, if we use the straight line method this month, also we use straight line method next month, and also we use straight line method in the other month for accounting for assets. That's what we're talking about. There is a similar treatment of like items within each period, or from one period to another. So for example, let us assume our item here is an asset. So when we depreciate an asset, we need to use the same method from one period to another. If it's the straight line method, it's from one method to another. And note, like this month we use straight line method, the next month we use reducing method. That one is not a consistency. So consistency means that when we use a particular policy, that policy is separate from one period to another. So there is similar treatment of like items from one period to another. Materiality. Now, when you talk about materiality, the concept of materiality comes in when if any information is omitted in the financial statement. So if there is any omission of item, if that item will affect the decision making process of the user, then that information is considered material. If it's omission. Now, if its omission will not affect the decision making process of the user, then that information is not material. So let us read. Information is material if its omission or misstatement could influence the economic decision of the users on the basis of the financial statement. So if it will influence the basis of decision making process of the user, then that information is considered material. Now, if it does not affect the economic decision of the user, if the misstatement or errors or omission will not affect the economic decision, then that information will not be material. That one is fine. Next, duality. Now, duality is the concept of double entry. For every debit, there must be a corresponding credit entry. So every transaction has twofold effect in accounts, and it is the basis of the double entry system or the bookkeeping, i.e. every entry, i.e. so that one you can say, i.e. for every debit there is corresponding debit, credit entry, sorry. So for every debit there is a corresponding credit entry. That is what we are talking about. Every transaction has twofold effect in accounts, and it forms the basis of the double entry system or bookkeeping. Substance over form. Now, substance over form recognize economic substance from legal form. It recognizes economic substance over the legal form. Economic substance over the legal form. Let me give you an example. Let me give you a good example for substance over form. So example, this one is not writing. Example. Now example of what? Substance over form. Even before you give the example, let us read the question. The transaction and events should be recorded based on the economic reality and not legal form. So when you do what? When you record transaction, you record them basing on the economic reality and not legal form. So that's what we call the substance over legal form. So the substance must be above the legal form. So when we record transaction, we should consider recording the economic reality and not the legal form. Now, a good example. So if we have along, let me give this example of a substance over form. Where is it? Let us say, for example, a company in Kenya, leases long-term asset. So a company in Kenya leases an asset, So a company in Kenya leases an asset that legally classify it as a rental. That legally classify it as rentals. That legally transfer it as rentals. However, the lease transfers. Substantially all risk and reward. Substantially all the risk and reward. Substantially all the risk and reward of ownership to the lessee. Of ownership to the lessee. This is the person who is leasing. Now, full stop. Now, the question is, so this is my question. Now, when we talk about substance of a legal form, now what is the legal form in this statement and what is the substance form? Now, in this case, number one, the legal form is rentals. Legal form is classified as rentals. So meaning in your financial statement, you should recognize these items as expenses. Now in the financial statement, you are supposed, so if it is a rental, then you are supposed to recognize the rental expense in the financial statement. But look at this statement. However, the risks transfer substantially all the risk and reward to the lessee. Now, if there is substantial transfer of risk and reward, then that one becomes an asset. It becomes a purchase. So, in transfer of substantially risk and reward, and reward to receive. Then it is recognized as purchase. Then it is recognized as an asset. So remember, when something is passed is when something when the risk and reward of something is passed to the next person, automatically that one becomes a purchase. That one becomes a purchase or an liability. So in this case, because it was like a purchase, is an asset, it becomes an asset. It's recognized as purchase of asset. Now, in the statement of the financial position, so in the financial statement, should we recognize number 2 as expense or an asset? We need to recognize them as asset. Now, the first one is a legal form. The second one is substance over form. Now, we are saying transaction and events should be recorded based on the economic reality rather than merely their legal form. Now, in this case, when you record, you shall not record it as an expense. No. An expense is a legal form, but you shall recognize it as an asset. So that's what we are talking about. The first one is the legal form, the second one is the substance of a form. So the substance of a form prevails over the legal form. That is what we are talking about. Next, business entity. Now, for the business entity, accountant regards business as a separate entity, distinct from the members. That one is fine. So the company itself is a legal entity which is capable of being sued, it can conduct their operation separately and without the owners. So the owners are separate entity. So when they pay tax, the business pay the tax as a business and not as the owners. That is what we mean by the business entity. Money measurement, all items shall be measured in terms of monetary value. So accounts shall deal with items. So the accounts shall only deal with items which monetary value can be attributed or can be attached. Historical cost. It is said that assets are recorded at historical cost. So singesema historical cost, ningesema at original cost. Original, supposed to be original. So it is said that assets should be recorded at original cost and not the fair value. And not the fair value or the market value, and not the fair value or the market value. Then you have the objectivity. It is said that the accountant should be free from bias. So objectivity is also called the neutrality, the word neutral. So neutrality concept also states the same thing, that the accountant should be free from bias. Realization, revenue, and profit are recognized when they are realized, just as accrual when they are realized, and not when the money is received, and not when the money. We call them the realization. We call them the realization concept. So revenue is recognized when earned. Revenue is recognized when earned, and not when the payment is received. Then we have the last one, time period concept. We call them the periodicity. The word periodicity. Now, the financial statement should be prepared for specific period, i.e., on a monthly basis, quarterly basis, or annually, or the yearly basis. So the financial statement should be prepared for specific period. So it said that the financial statement should be prepared for specific period. So we have other concepts, for example, like full disclosure concept. You can go and look at it. 14, full disclosure concept. Which states that all the relevant and necessary information must be disclosed in the financial statement. All the relevant and necessary information all the relevant and necessary information, all the relevant and necessary information should be recorded in the financial statement. Should be recorded in the financial statement. So that marks the end of our class. So those are some of the things you can find in an exam. So that marks the end of topic 2. So when we meet in our next class, we shall meet and do an adjustment. So that will be our next topic. Topic 3. An adjustment of financial transaction. Adjustment of financial transaction. So the pen imeisha ink, but imeisha wakati mzuri. So when we meet in our next class, we shall talk about the adjustment of the financial transaction before we prepare the final accounts. Before we prepare the final account. So I want to wish you well. So let us meet in our next class. That will be topic 3.